Hello, everybody. I want to welcome you to this special training, and we're going to get right into it. We're going to assume that the person that you're talking to has just seen the 4-minute video. So we're going to ask them this question. So now do you see the positive impact that this product can have on a family? And then you're going to explain to them, rather than just get right into the living benefit product, if it's okay, what I want to do is I want to give you a quick overview of who we are and what we do, so that if you have other questions that come up, you'll be able to refer those questions to me and I'll be able to get the answers for you. And so our company is a 3.5-year-old Atlanta-based financial service marketing company. And that sounds like we're a young company, but the truth is we have an extraordinary success track record. Our CEO has been in this industry for almost 40 years, and he developed a system. And he used that system to build the two largest financial service marketing companies in the history of the United States. Both of those companies are still in existence today. Both of them are billion-dollar market cap companies. He is now building his third company, which is what you're about to see. We have virtually every type of product that you can think of, but we always think of living benefits as our centerpiece product. It is what we call the product of the decade because it is such a versatile and needed product in our society today. We also know that the average person would like a much better opportunity to win the money game, and that requires financial literacy. If you don't know something, it can absolutely be devastating to your family. And so we always start by letting people know about the 3 basic rules of the money game. The first rule is the rule of 72, and this was developed by Albert Einstein. It says that if you will take the number 72 and divide it by any interest rate, the number that you get for the answer will tell you how many years it's going to take your money to double. So just for example, let's say that you take your money to the bank today. The bank is going to give you about 1%. You take that 1% and divide it into 72. The answer is 72. That means your money will double every 72 years. So let's use a different interest rate. Let's say you could get 4%. Well, you would divide 4 into 72, and the answer is 18. So that means that your money is going to double every 18 years. So if you're 29 and you have $10,000, 18 years later you'll be 47 and you'll have 20,000. And 18 years after that you'll be 65 and you'll have 40,000. And that's how it works. What do you think the average person would think would happen if you double the interest rate? Well, a lot of people would think that you would wind up with $80,000, but that's not what happens, because here's the way it works. Remember, you take the interest rate and divide it into 72, so if you divide 8% into 72, the answer is 9. So now your money is going to double every 9 years. So you're 29 and you have $10,000, and then you are 38 9 years later and you have 20,000. Then you're 47 and you have 40,000. Then you're 56 years old and you have 80,000. And then you're 65 years old and you have $160,000. Now, if this is your retirement money, this is very important. But let me ask a question. Do you know anywhere, or do you know anybody that can consistently get 12%? And the answer is your bank. Because I can take my money to the bank and give it to them today. They will give me 1%. And if you want to go to the bank and borrow money, they will loan you my money, but they will charge you 9% to buy your car. And then if Mary goes into the bank and wants a credit card, they might charge her 15 or 16%. And so the bank keeps my money loaned out, paying me virtually nothing. And here's what the bank is getting. They're getting 12% interest, say, as an average. And if you divide 12 into 72, the answer is 6. The money doubles every 6 years. So 29, then you're 6 years later, you're 35, and you have 20,000. Then you're 41 with 40,000, 47 with 80,000, 53 with 160,000, 59 with 327,000, and then you're 65 years old, and there's $640,000. unfortunately that money belongs to the bank and you wind up with almost nothing. And that's why the banks own all of the large buildings in town. And so this rule is very important, because if you know how to use this rule, you can make it help you. But if you don't know how to use it, somebody is probably using it against you. And so now the second thing we're going to look at that's very important is how taxes affect your money. And there's 3 ways that you can be taxed. First is you can get taxed now. People put money in the bank and they put after-tax money in the bank, and when the money grows, they get taxed on it. Tax later is a lot of people have a 401k or an IRA, and there's a tax break that they get up front, but when they go to pull the money out later, they have to pay tax on it later. And the analogy that we use is if there was a farmer, he has a bag of seed in his hand, and the IRS comes up to him and says, you're about to plant that seed and you have to pay tax. So you can either pay tax on the seed in your hand, or we'll come back after you have grown the crop and harvested the crop, and we'll take the tax out of the crop. And so the farmer would ask him, well, how much tax are you going to charge me if you take it out of the crop? And they say, well, we don't know that. We'll figure that out between now and then. There is a problem with having the 401k, and that is that taxes are probably going to go up. So you'd much rather pay tax on the seed than on the harvest. Now the third thing, the bucket says life insurance or an IRA, a Roth IRA. Well, those products, you do not have to pay tax on the growth of that money, but a Roth IRA has a limit on how much money you can put into it, whereas the insurance product is not totally unlimited, but it's virtually unlimited as to how much money can be put in that insurance product. And this is what wealthy people have used for years and years and years, but they just didn't tell us about it. And the great thing about that life insurance product is you never have to pay tax on the growth of that money. And so the third thing that we're going to look at is how money grows. It either is going to grow as a fixed interest rate, like 2, 3, or 4%, very low interest rate. Wealthy people use this. They've got a lot of money. They don't want any risk. And so they get a small interest rate and they're happy. And then the variable is used by the average person because they're trying to make money in the stock market. And so if you look at it, it looks like an EKG going on or a possible heart attack. And so when the market goes up, things are great. When the market goes down, you're losing money, which is not good. And so the third is the indexed product. And the indexed product says this. It says when the market goes up, then you can enjoy double-digit rates of return. You can get 10% or 11% or 12% or 13%. And then they put a cap on it at about 13%. So if the market did 18%, you could only get 13%. But they also have a floor so that if the market drops by 50%, you don't lose any money. You can go up with the market when the market goes up, but if the market falls, you don't lose any money. If you have $100,000 in the account and the market goes down by 20 or 30 or 40 or 50 or 80%, you don't lose a penny. You still have $100,000. So the question is, how would you like your money to grow? And the answer is, you would want it in an indexed product where you cannot lose money. You would want to be able to get double-digit rates of return if it's possible, and you would like to never have to pay taxes on the growth of your money. This is extremely valuable information. Now, we represent a lot of companies. We're a broker, and we can look over the horizon, pick out the very best products for the client, and those are the products that we market. And that enables us to be loyal to the client's needs, not to one company or their products. And we have 2 types of products. We have licensed products where you have to have an insurance license to be able to market the products, or we have non-licensed products. And these non-licensed products, we call them concierge products. And a concierge product, we don't have to know how to explain it. All we have to do is be able to recognize the person that has the need and introduce them to the company and let the company explain how they can solve that problem. And if a commission occurs, then we get paid for that. And so those are special financial situations that people get in and they need help to get out of, and we're able to help them. For example, let's say that they owe the IRS a lot of money at the end of the year because their business has been good. And so there's a way to reduce the amount of money that they owe the IRS and actually be able to use that money for their own benefit. And if you have a debt problem, we have several options on how to help you with that debt problem. But the bottom line is we are loyal to the client's needs as opposed to any one company. So here is a summary of what we do. We do all types of insurance products. We do all types of retirement plans. We protect against sickness. We cover disability. We teach people how money works, and we teach people how to minimize their taxes. And so what I want to do real quick is I want to introduce you to two valuable concepts, and then we'll introduce you to the product of the decade, living benefits. And that product of the decade is an amazing product because it protects the family, it helps you build your financial house, and it helps you meet your financial obligations. So let's look at the first concept. The first concept is how you build your financial house, and everybody is building a financial house, whether they know they are or they don't. And there's a good way to do it, a bad way to do it, a right way to do it, a wrong way to do it. But the correct way to build the financial house is you start with the foundation. Foundation is the most important part of the house, and that foundation in the financial world is protection. Protection of what? Protection of your assets. So in other words, if you have a cell phone and it's worth $1,000, you probably would have some $2 or $3 monthly charge for insurance so that the insurance company would replace the cell phone if anything happened to it. And then you have the same thing with your car. You have $30,000 in the bank and your car is worth $30,000. But do you need insurance on the car? Sure. So if you damage the car and you don't have insurance, then you're going to have to pull the $30,000 out of the bank and buy another car. It's easier to let the insurance company replace the car. And then you have the same thing with your house. You have homeowners insurance. And then you have certain jewelry that is to be insured. But you also have things that are coming at you in the future that need protection. One is the education for the kids. In order to help a child get through the entire educational process, it's $200,000 to $300,000 if you really get them through college. And then the last thing is retirement. You know, you've got to take care of your own retirement. And so there's something in here, there's an asset in here that's missing. And what would that be? Well, it's you, because you are the most valuable asset that the family has. You're like a printing press that prints money. You go out and work and all month, and then you come home and you've brought this money with you, and you use that money to support the lifestyle that you and your family have. If something happens to that printing press and it no longer prints money for some reason, then the whole lifestyle collapses. So you have to be protected. And then after you have the protection in place, then you set up an emergency fund, which typically is 6 times your monthly income. And then you will eliminate bad debt like credit card debt, and then you'll do investments. And that's the way you should build the financial house. So let's look at the second concept. I love this because it's called the theory of decreasing responsibility, and it says this. It says when you're younger, you have a lot of financial responsibilities. And you do. You have normal debt that you have. It could be student loans, and you've got automobiles that you're having to buy for the family. You have a mortgage. You have to educate or think about educating the kids. And then you have just normal living expenses. That doesn't leave you a lot of money. And so you have all of these responsibilities, and they're your responsibilities. But there's one other thing that needs to be being done here, and that is you need to be saving money, because at some point you're going to wind up being older and you're going to want to retire, and you don't want to be a burden to the family at that time. So you have to start saving early, like now. And so can I ask you this? Are you able to save money now? Okay, so you save $150 a month. I understand. And can I ask you where you put it? I mean, people put it, a lot of times they'll put their savings in banks or mutual funds, or they'll buy property, or they'll put it in gold or stock or something. Where do you put yours? So you put it in the bank. You have all these responsibilities and you're trying to save money. And the best way to handle those financial responsibilities that you have is to transfer those responsibilities onto the shoulders of an insurance company by buying something called life insurance. And when you do that, that gives you peace of mind because you know that the family's taken care of if anything should happen to you. So you need protection for the family, and you need to be saving something. And so let us introduce you to Living Benefits. This is an amazing product. Living Benefits is an insurance product that says this: if you come down with a critical, chronic, or terminal illness, and that could be like a light heart attack or a light stroke or a cancer, you get down with it and then you come up and you're okay. So if you come down with a critical, chronic, or terminal illness, then very often you can reach inside the death benefit and pull out a major portion of the death benefit and be able to use that money for whatever you want to use it for and never have to pay the money back no matter what. Now, the reason that we know that this is important today is because the average age of a heart attack, stroke, or cancer victim today in the United States is 43 years old. And most of those people are going to wind up surviving that kind of a sickness, but they're going to wind up going bankrupt. And the reason that we know that is because 62% of the bankruptcies are due to medical expenses, and 78% of those people had health insurance. So the bottom line is that most Americans are going to wind up getting sick before they die. And they can survive a heart attack, a stroke, or cancer, but a lot of times they can't earn the income that they used to earn before they got sick. So that Living Benefits actually can be the difference between a family having to live in poverty or being able to have a good life in the event that something dramatic happens inside the family. Now, we had an occurrence that happened in our office with one of our agents and a client of his, and AIG came down and did a 4.5-minute video on this situation. And so I want you to watch this video because it'll show you what a positive impact this product can have on a family. So please watch this video.
Accelerated benefit riders is a big deal to me. Unfortunately, most of us are going to get sick before we pass away. So if we get sick and we can be with our family and go through things that we otherwise wouldn't have had a chance to do because financial issues are not an issue anymore, that's the whole key.
So John and I go back a long ways. We were friends from church. I'd had some life insurance policies with him, and we discussed this new product that came out, the Quality of Life insurance. My first thought was, I'm healthy. I don't need this. Never been sick. Never really been in the hospital. We discussed, what the coverages would be, and I signed up for the Quality of Life. Started having a lot of shoulder pain, and thought that it was just maybe a injury from playing sports. The diagnosis came for multiple myeloma, bone marrow cancer, and we started chemo in September of 2013, got out, finished the chemo in January, and that's where my doctor started talking about the need for a bone marrow transplant. Leading into the transplant, I had lots of bills coming in, as you can imagine. And so I was just kind of overwhelmed at that point. John was one of the friends that I called just to tell him what my situation was. He reminded me of the accelerated benefit rider on my Quality of Life policy that I had.
I immediately called AIG, and I must say they were very professional, and the claims department was all over this.
Claims department said that you qualify for $627,000 and some change, and I was floored. If this is really real, what a life changer. It was a unbelievable stress relief that you can't even explain. Benefit rider helped tremendously, more than I can even ever say. With the benefit of the money that I got, I decided that I would go try to find a place on the lake, and found a little place on the lake and bought it. Was able to pay cash for it. No mortgage, which is a very big stress relief. My son was interested in buying a house, and with the benefits of the money that I received, I was able to help him in a down payment situation to where he could get a very low payment, and he was very thankful and blessed for that situation. My daughter, actually September 8th, my birthday, got engaged, and I knew that prior to this, I didn't have the money to put her through the wedding. And with this, provided me the opportunity to give her the wedding of her dreams. The other great thing that I was able to be there to walk her down the aisle.
Just having the chance to help families get a check to go through all that. That's what AIG is about.
Be able to enjoy life while you're still here is a blessing that cannot be matched by anything.
So that is a very strong testimony about the positive impact that that product can have on a family. So let me ask you a question. Don't you think it would be a good idea to have that product if you could get it? Okay. Well, now there's one other element about that product that I want you to know about. A lot of times people are trying to save money. So they put money in a bank, or they put it in a credit union, or they put it in stocks, or they buy CDs, or many different things, but they're trying to save money. There is a way for a person to take the money that they're trying to save and to put it inside one of these products with living benefits. And if you do that, then there are certain benefits that are given to you automatically that you cannot get anywhere else. And I want to show you what those 4 benefits are. This is growing your money inside this type of a product. The first benefit is this. You're able to take advantage of a thing called the Rule of 72. And in short, the Rule of 72, which is the basic foundational rule in the money game, it says that the higher the interest rate you're able to get on your money, the faster your money will grow and double. So you're able to get double-digit rates of return here when the market is really doing good. So you can get 10, 11, 12, 13%. But a lot of times the market's not doing good. It'll have a correction, or it can crash. So the second benefit is this. If the market decides to crash and goes down 20% or 30 or 50 or 80%, you don't lose a penny, because you can go up with the market, but when the market goes down, you can never lose money in this product. If you have 100,000 in the account and the market crashes by 70%, you still have $100,000 in that account. Now the third benefit is this. If you want to take money out of a qualified plan, 401k or an IRA, and you want to take it out before 59.5, then there's a penalty of 10%, and you will wind up paying taxes on it. This product, the benefit is that you can put virtually an unlimited amount of money in here, and you can have access to that money. As the money is growing, you can have access to it without any penalty. You can reach in and pull out the money that you need, use the money for whatever you need it for, and you never have to pay that money back. And when you pull the money out, for whatever reason, you never have to pay taxes on the growth of that money. Now think of that. You're able to take money and put it in this product and have the money grow with the market as it goes up. And when the market falls, you don't lose any money. And then when you want the money, you have access to it without penalty. And if you pull the money out, you don't have to put the money back in. And you never have to pay taxes on the growth of that money. And while you have those three benefits that are there available to you automatically, there's one other benefit that you have, and that benefit is that you're protected by living benefits against death, disability, and sickness. So let me ask you this question. Is there a better way to protect the family and to save and grow your money? And the answer is there's not. Do you know anybody who needs to know about this incredible information?